Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is March 14th. We're edging closer to the end of Q1. And we have Brent crude oil trading above $84 a barrel, and most notably closed yesterday at 84.21, which would represent a closing high thus far this year, thus far this quarter. Vanda Nahari, founder and CEO of Vanda Insights. Does that represent a breakout? Have we finally moved out of this tight band and we're now going to, with the arrival of the second quarter, ascend the mountain a little bit higher up the oil price as we would seasonally see a bigger demand period? Is this a breakout moment? Your thoughts?
Good afternoon, Sean. Not necessarily. I think yesterday's rally, in large part driven by news of a second consecutive day of drone strikes by Ukraine onto Russian refineries. And we know seems to be a new phase in the Ukraine-Russia war, that Ukraine has started now attacking Russian oil infrastructure since January. So that was a key reason behind the rally. And of course, the US weekly stocks data as well turned out to be a little bit bullish. Unexpected drawdown in crude stocks and huge drawdown in gasoline stocks. The reason I say not necessarily a breakout into the higher range is that I feel, look, this is an election year in the US. I don't think Washington wants Ukraine to be pursuing this strategy, which is obviously going to lead to higher prices, So I would expect Washington to step in at some point to rein in this kind of warfare on the part of Ukraine. So, and on the other hand, we have the economic worries. I think they're going to continue and weigh down crude prices. So, no, I don't think we're ready to break out of the range onto the upside.
Paul Hicken, editor-in-chief of Petroleum Economist. Is this a geopolitical risk premium inflating, or have we got fundamentals underpinning this rise into the end of the quarter?
That's a good question, Sean. Thanks for having me back on. I think for starters, there is at some point going to be a slight creep higher for oil prices. It's going to start creeping higher. Stocks are drawing down. I think the demand situation is improving, and OPEC is doing its job in terms of withdrawing supply. Yes, we've had certainly people spotting that compliance is patchy with places like Iraq and Kazakhstan, but that's in a sense always been the case with OPEC. They've always had some compliance issues, but ultimately they're draining the swamp. So I think there is going to be at some point a shift higher. Is that the moment now? I think it's hard to say, because you do have, like Vandana has said, talked about the drone strikes as adding a little bit of a risk premium. How much is this? Again, it's still only a small amount of risk premium, I would say, because let's face it, these are Russian refineries. They're underutilized. They're a lot of them old refineries. They're designed to withstand a lot of these sort of low-level drone strikes. But yes, it is a certain worry for the market. But I think at the moment it's a low-level risk premium combined with there is going to be a creep higher. But again, are we looking for more than that's there? Because realistically, prices are in a very stable, steady way, and these aren't the sort of moves that are really going to, you would think, break it out of its funk at the moment. You'd probably need something a bit more clear cut about with the economic outlook. When the market really starts to think about potentially supply coming off the market, and we're not really there yet. So I think, yeah, like Vandana says, early days.
Dr. Aman Nassery, Managing Director, Middle East, FGE Dubai. Dr. Aman, and again, sort of sticking with this analogy of a breakout or possibly a shift in sentiment here. We've lived a lot of the first quarter with the idea that the 6 million barrels of OPEC plus oil capacity, this sort of idle, the supply cuts as they're called, were a kind of a bearish, there's lots of oil supply around. But now as we start seeing the arrival of the second quarter, we're reminded that they are actually oil cuts, and this is potentially going to be a tight market. And so the price lifting on the back of that sentiment shift. Your thoughts?
Yeah, I agree with both Vanden and Paul that there is a little bit of.
So you don't agree with me? You're fired.
No, no, I agree with the fact that there is some risk premium, and in line with your question. But I have to also emphasize that, as Paul said, that is very limited, if any, and it's basically very much in line with what we expected, that the prices will be on an upward trend to an average of $85 perhaps by May and June. So our forecast for April was for $84 on average, and now we're maybe half a dollar to a dollar in addition to what it should perhaps be according to fundamentals in March, but maybe we're there a bit earlier, also encouraged by some risk premium together with some stocks data. So yes, the cuts are at play. They are basically forcing some tightness into the market, and inventories are drawing. We will continue to see a balance to tight second quarter, but depending on what's going to happen in third quarter and fourth quarter, we're seeing $85 to $9 range. So again, this is all in line. And like I said in our last Daily Energy podcast that we had, there are so many risk premiums at play here, and basically the market has lost track of how to integrate all of them. So the impact is a compound impact, and individual impact is hard to disintegrate, to say, okay, this is basically the fear from the loss of more Russian oil infrastructure.
Let's stick with the Russian theme, Vandana, because in your Vanda Insights today, you referenced that Russian President Vladimir Putin has again threatened the West with the sort of reminding them that they have a lot of nuclear weapons. We also had this, obviously this is re-election week of Vladimir Putin, which in itself also, I suppose, obviously a foregone conclusion, but ultimately in that week, he has also reiterated his commitment to OPEC Plus. I mean, that sometimes gets questioned, but he's very categorically put that forward, that he's still very committed to this. Those elements also feeding into, with the drone attacks all together, act as a fairly bullish sentiment, would you think?
Yeah, I think Russia's continued commitment to OPEC Plus is a given, Sean. I think without Russia, OPEC Plus.
I mean, I'm not sure it's a given, to be honest, because 4 years ago, there was a massive fallout between Russia and Saudi Arabia. And only 3 months ago, we had the Russian president coming into the UAE and Saudi Arabia on the back of a very fractious OPEC Plus meeting. So I would challenge that thesis that it's a foregone marriage. It's one built in a slightly stressful marriage.
Yes, Sean. So maybe I should have put it more clearly. I mean, as long as OPEC Plus is there, as long as we are talking about OPEC Plus, the presence of Russia and the cooperation of Russia is a given. That's what I mean. In other words, the other side of the coin of saying the same thing is that if Russia were to walk away tomorrow, I doubt OPEC Plus would exist. And then as a corollary, almost, I doubt even OPEC would exist. You know, it would be such a disastrous development for that whole alliance that probably we'll see.
There is something in between, isn't there? Like we saw 4 years ago, you can have a temporary separation. I'm moving out. You keep the kids. I'll be back in a week. That's enough to throw the place into some disarray. That's always there. As we saw something close to that, I think, in December when we had the Saudi energy minister tell us in great detail how the Russians were going to be checked by the secondary sources, and that in itself told its own story.
Yeah, but has there been any more sort of rap on the knuckles for Russia? No. Have we seen clear third-party data and evidence of Russian exports? We haven't. So sometimes it's about, what is the optics? You need to present a picture of, cohesion, but also of discipline and how the errant members are being disciplined. That's the optics part. And then sometimes there's just the ground realities part, right? So yes, Saudi Arabia has every reason to keep Russia in line, and I believe they would, and that's what they would say publicly. But how practical is it for them to do it? Because again, question of, does Saudi Arabia want to push Russia to the extent that Russia decides to walk away? No. So in a way, this is quite an equal relationship. I wouldn't say that Saudi Arabia holds all the cards. And now I've even forgotten what your original question was. So I
Well,
hope
that's all right. That's a successful podcast when you forget the question rather than the opposite. Now, Paul, is this a moment? I asked it earlier in the week that this kind of price is obviously now moving beyond the Goldilocks, because you'd say 80 is the Goldilocks number for producers and consumers. That this is another victory lap for OPEC plus discipline and market management for the Saudi energy minister.
Yes, I would say I agree, Sean. I think it is a win. I don't know if we quite moved past the Goldilocks phase at the moment. I think 90 is probably a point where everyone would still kind of slightly uneasily still be in that range, be happy, because you've got to remember that while it is a sweet spot, while we're producing consumers we're in kind of a balance between producers and consumers. I think you've got to remember, like, to refer back to what you were talking about with Vandana, which is it's still been a pain point for OPEC plus. They've cut much more than they would have liked. These voluntary cuts, the split with Angola, the move from production to exports with Russia, and this kind of jostling over that position. It has been a pain point, but at the same time, OPEC have done what they've always said they'd do, and they've balanced the market. They've managed the market. It might have been harder, but it's back to the old teabag analogy. OPEC only starts working when it's in hot water, and it's delivered. So yes, we are in a position, and I don't think OPEC. I think what's important here as well is that even with prices creeping up higher, even in election year, I think OPEC plus will be reluctant to unwind quickly or move, because once you unwind, it's very hard to get that genie back in the bottle. And I think even if we start seeing prices up towards the 90, I think OPEC plus will probably delay it as long as possible, even with that June meeting. And that June meeting will be a very interesting one. And I think that, assuming prices do keep creeping higher, which they may well do, and I think may more than what Iman was suggesting, potentially we could well see 90 by June.
Dr. Iman, I wanted to just pick up on that, just to shift a little bit, to bring natural gas into the conversation, because Europe has got pretty lucky this winter again, mild winter, full storage now. We're coming sort of to the end of winter in Europe, with US gas storage, very unusual for end of winter to be full or near full, and gas prices to be on the floor. Your outlook for that, and does that present a challenge for the sort of a bearish potential sentiment for oil because of the potential crossover that gas offers as an alternative to oil in certain scenarios?
Yeah, no, you're right. And we lightly discussed this on the last podcast when prices crashed, is that the warm winter and the well-prepared inventory levels, gas inventory levels in Europe basically nailed and pulled the prices down to historic lows over the past few years. And what we're looking at ahead of us is obviously a lot weather dependent, but looking at fundamentals, gas supply availability through pipeline and LNG in Europe, as well as the rest of the world, which currently we see now Northeast Asian prices of LNG kind of coupled with the European LNG prices, and basically there is a $1 to $1.5 per million BTU differential, but that linkage in place and bringing the gas situation to global. We see next basically prices to remain below $9 until later toward third quarter and creeping up toward $11-12 per million BTU this winter. Next year will be even better position for the gas market and for Europe, and then ultimately in 2026 when the new LNG prices will come, we expect lower prices. So I think for Europe and for gas, that crisis is over unless again we see a massive polar vortex or something in either of the two upcoming winters. But I think the gas dynamic and the gas dilemma in Europe is somehow well managed, and we don't see any crisis ahead of us.
Vandana, you might just pick up on that from an Asian point of view. Does these discounted gas prices offer relief in Asia? Does it offer the opportunity for some crossover?
Oh, absolutely. So in Asia, of course, China is the biggest buyer of LNG on both term and the spot markets. India is a major buyer. Other South Asian neighbors of India as well, Pakistan, Bangladesh, which actually the two of them had quite a bit of trouble through 22 and 23 picking up spot cargoes. Now, all of these countries, South Asia, Southeast Asia, they do depend on the spot LNG market to satisfy quite a bit of their demand, and that's where they were really in trouble through 22 and 23 because Europe was pulling up all the spot LNG, paying top dollar for it. And as Iman says, with Europe quite comfortable now. Actually, gas storages are quite comfortable even in North Asia. I understand in the US as well. So all around, it's plentiful of gas and storage. It's definitely gives plenty of breathing room, and it encourages spot imports. In fact, spot, as Iman was saying, if $8 or $9 per MMBTU for spot LNG into North Asia is actually even cheaper than what they are getting under their long-term contracts, which tend to be linked to Brent prices. And at $84 Brents, it's more expensive than spot. So they will try and maximize spot LNG. Definitely a good sign. But longer term, I think Asian countries are now starting to rethink what their strategy ought to be with regards to the ratio of term and spot, because I think 22, 23 are going to be hard years for them to forget, especially the more price-sensitive buyers. So they'll probably want to take more term LNG, and especially as a whole new wave of projects is coming on stream in 26. I think we'll see some interesting times ahead in terms of buying spot versus term patterns.
Paul, just to pick up on the sort of bullish idea that there's certain elements here that, as I started the conversation, that this might be a breakout moment to the upside. The other is inventories, right? In terms of oil, crude oil stockpiles in the US unexpectedly decreased ahead of the summer driving season, as reported by the EIA, and the other being the gasoline inventories down for a sixth straight week. These are all tightening in the good old days of sort of basic fundamentals impacting the oil markets. These are what they look like, and weeks of declining stocks does tighten the gills with supply cuts. These are all upwardly mobile. Your thoughts on the role inventories, tightening, declining inventories could play as we go forward? Yeah,
it's a good point, Sean. And yeah, exactly. Nobody buys crude. People buy oil products, and gasoline is the key one. We're not even approaching the driving season yet, and gasoline stocks are low. So there is a certain tightness in the product side, which is going to feed onto this potential creep into ultimately higher prices. There's the other issue of feeding into this factor is basically crude quality. US is still producing a lot of light sweet crude, but the OPEC are taking out a lot of heavy sour, and that does play into blending, does play into refining, underutilized refineries, and it does mean it's going to may be required to get to the same level of products we might need. So there is a certain tightness that's going to be playing out over that time, and that is why I was suggesting that we could start seeing $90 a barrel towards when OPEC Plus meet at the 1st of June. So it's definitely one to watch. And I think this is the thing with the oil market as well. I think you know, we start seeing things in terms of facts and balances, but narrative also is huge in terms starts to drive what is the factors. We talk about the disruptions in the Red Sea, but then we talk about OPEC spare capacity as being an offsetting factor, or some. But then that's not oil on the market. How much you talk about stocks and how much you actually talk about what's going to come into the physical market? Because technically the US could still, you know, US SPR is still something that could be used at some point.
We saw it aggressively used 2 years ago in the run into the midterm elections,
and now they could use it again. It's something that still could.
Certainly, if gasoline prices at the pump start going up, which they are now, and it's early days, as you say, ahead of the driving season, there's plenty of time to add $1 onto that pump price. Let's go to the survey question, which sort of addresses a little bit the thesis of what I was suggesting today. How much geopolitical risk premium is in the current oil price? A question we've liked to ask regularly this year. Is it 7 plus? Is it 5 approx? Is it 3 approx? Is it 1 or none? How much geopolitical risk premium is in the current oil price? Brent crude oil trading at $84 a barrel. How much of that? Mike McGlone from Bloomberg Intelligence was on. He'd be telling us it's $20. You don't even have it on the options list. But what is your view? And we'll post that on social. Where is that at this time? Dr. Mann, on that question, obviously we have the ongoing situation in the Red Sea, and reports every day come out. Missile from the Houthis was shot at this or that, and the US and the UK bombing into Yemen as a result, and that sort of goes on every day. And we have a story in the FT about the US holding secret talks with Iran over the Red Sea attacks, which would indicate that this is a managed affair to me, in the sense that nothing's getting out of hand here. Your thoughts on where this sort of geopolitical fracture of the Red Sea, Iran-US relations at this time, this escalating, not escalating, and being a big factor for the oil markets?
Sure. I want to emphasize that there's always been two lines of dialogue and conversation between Iran and the US. One is for Iran's domestic affairs and its own nuclear and missile program and human rights, this and that, which is basically for affairs inside the country of all sorts. And then there is the Iran's regional involvement, one way or the other, either through its proxies from Syria, Lebanon, the whole crescent down to Yemen, or even neighboring countries such as Afghanistan, Pakistan, Azerbaijan, Armenia. And the conversations that the US have different administrations have held with Iran were in these two lines. The second, for its regional involvement, has always been, they've had talks before regarding situation in Iraq, in Afghanistan. They have even worked together regarding ISIS and whatnot. So that remains perhaps not so relevant directly to the oil market for the concerns that we have here, and it has little to do anything to do with the sanctions on Iran. That's more of a give or take situation. I've never got any feeling or indication that those conversations were basically linked to the negotiations regarding the nuclear and missile and those that Iran have been put on the sanctions. So that, I think, what you heard and FT reported might be going on, but it has nothing to do with the other one, which I want to say that my view is that we're over. The Biden administration and Iran is no longer really talking much about, or neither side have much of a hope to unlock where they left it. However, in my opinion, they have left it in an interim middle ground deal, which
And
has
does that
unlocked
interim middle ground, does that allow, part of that sort of unspoken, allow Iran to export as much oil as it can? Is that sort of...
That's what I see. That's what I think has given the markets comfort, and especially some of the players in China, I call them tier 2 market, which didn't touch Iranian oil and products before. Now they do because of this unwritten deal. But I want to emphasize that if Trump was re-elected, that deal, that situation will certainly be no longer in place. Most likely scenario is that Trump is going to bring back the maximum enforcement, maximum pressure. But will we see all of the Iranian oil that has come to market under this current situation, which we call an interim deal, unofficial interim deal, out of market? I don't think so. There have been so much infrastructure built in terms of shipping, storage, middlemen, network, bilateral trade through goods and services, that it's hard to undo all of them. So I think there will be some impact if there were a Republican or a Trump back into the office, but it will be somewhere in between Trump round and current situation.
Vandana, China, of course, remains one of the big pillars of the oil market. Demand there, still the world's largest oil importer. 3 months into the new year, are the kind of bearish sentiments that China is in some sort of structural decline, or is that overselling the structure of the status of China, at least from a demand oil consumption narrative?
So we had the National People's Congress, which concluded earlier this week, and no surprises there. Not only that, but I think it left, in general, the market, investors and economists rather underwhelmed. They set a 2024 GDP growth target at around 5%, which is same as last year's actual growth reported by China, 5.2%. You think that the signal that they were trying to send out to the market, it's steady as she goes, to the Chinese population, be patient, we'll get there. But if you look at it from a market's perspective, including commodities markets and oil markets, certainly, I think it's pretty much a picture of continued sluggish growth, which means, to my mind, so last year, we estimate China saw a demand growth of about somewhere between 800 to 900,000 barrels per day year on year. I think that pretty much accounted for the bulk of post-COVID or post-reopening rebound that we were going to see in China. I think this year it's going to be much lower, probably closer to 300 to 400,000 barrels per day year on year. The analysts and CNPC seem to be pointing in the same direction. So look, as far as oil consumption is concerned, the property market is still in the doldrums. Manufacturing exports is not doing too well. Consumer sentiment is not too good. And then there's very strong growth of EVs, which continues to replace a lot of what would have been in the old days strong growth in gasoline demand. So all of this put together points to a picture of very muted growth. Of course, continued growth, recovery in Chinese oil demand, but quite muted. Look at what's happening to iron ore prices. That's a direct reflection of what the market thinks and sees is happening in China, right? This raw material for steel, China is the biggest user. And we've seen iron ore prices slump from 140 at the start of this year to 100, close to $100 a metric ton. I think that pretty much sums up the picture of not just oil, but in general commodities in China.
Yeah, iron ore is a good one to watch as the benchmark of China's health. Last word to you, Paul, to where you started. We have oil moving up slightly on the back of our conversation, probably. No, 84.16. But you said that it would take something more significant, something very definable for this to be a breakout moment or for a breakout moment to occur. what do you see that could be defined as that? Is there anything on the horizon that you would say could qualify to be that?
I think I want to qualify that just as a final word as well, is that
Please.
yes, there is some potential for breakouts with a defining moment, but I think also that narrative has a way of taking hold. And I think if you do start seeing improvements in, you know, the US economy, the interest rate trajectory, if that starts to change, China, it's a huge swing factor. They could start seeing a real improvement if we start seeing an improvement in Chinese economy, that could also start leading to prices continue to start taking a momentum above the 85. Technical factors weigh in, and you start seeing that momentum up towards 90. So I think all the likely breakout factors from more confident to be about is on the upside, and I think you could just start seeing a creep higher as a result of all the confluence of factors, the lower stocks, the general sort of change of the market balances, and the market starts to really hang on to that. And I think that's really where we're at.
Okay, well, we'll have to leave it there. It's 11 o'clock UAE time. Brent crude oil trading at $84.16. Will the market close higher today? I think could be a very important signal, or does it retreat from what might be dizzying heights? A closer higher could reinforce my thesis of today that this might be the breakout into the second quarter. We'll wait and see. Iman Nassery, thank you so much as always. Vanden Harry, as always, great to have your insights, and Paul Hicken for your contributions. We see here the survey consensus around $5, but also $7 plus. Getting a bit of attention on the geopolitical risk premium. We'll post that on social for others to vote on and see where it ends the day. Thanks very much, guys. All the best.
Thank you.
Thank you. Bye.
Mike McClone voting by the looks of it. Thank you.